money nerds out there, it's Benjamin Mitchell. Welcome to another episode of Headsup on Money. I hope you're all well, have had a nice week. And it is that time again, it's Personal Finance Friday. And it's one of the good episodes this week, money nerds, because it's not just me rambling at you. We've got a guest on the podcast by the name of Lars Kroijer. I hope I'm pronouncing his name correctly, and I'm sure he'll tell me if I'm not. Lars is an incredible guest for us to have on the podcast because I read Lars's book, Investing Demystified, a number of years back, and it really resonated with me because a lot of Lars's principles and how he encourages you to view your personal wealth really resonates with what I do as a financial advisor and the points that I lament nearly every week to you money nerds, that you do not need to reinvent the wheel when it comes to your wealth management, and simplicity is often best. Now, Lars comes at this from an interesting angle in that he used to be in the hedge fund industry. So he's a incredible guest for us to have on the podcast. I'm sure you agree, to tap into his knowledge of that world and how this has perhaps shaped his views on the world of investing now and ultimately led to his book, Investing Demystified. So great guest to have on the podcast. Welcome, Lars Kroijer. Hi, Lars.
Thank you. Thanks, Benjamin. Thanks for having me.
No.
It's a very flattering intro. I hope I can live up to it.
No, it's great. It's great to have you, Lars, because I genuinely got tons of value from your book, and I'm in this world, and I think it was written, perhaps correct me if I'm wrong, very, very much with end investors in mind and encouraging them to ignore the jargon that often accompanies our profession and run with a lot of simple things themselves. Is that fair to say?
No, absolutely. I think there's a skill to try to make relatively complex things simple sounding. I always actually thought of my mom, right? Because my mother, I used to run a hedge fund. I started and ran a hedge fund. My first book was about starting and running a hedge fund. And my mom would always think she, among her friends, would have the best angle you can possibly have. She had a son, some Danish, right? My mom lives in Denmark. And she had a son who was a hotshot hedge fund manager in London. So when she talked stocks, everyone should listen. And I was a continuous disappointment for her because I didn't want to talk stocks with my mom, and I didn't want to give her stock tips. And besides, what we did were these kind of hedged arbitrage type positions that had no resemblance in any way to the kind of portfolio that someone like my mother should do. But I also felt a little bit aggrieved when she would go down to I won't say which financial institution with her savings, and they would kind of put her in these incredibly high-priced products managed by people that were charging a lot, but over time not adding necessarily a tremendous amount of value, and also importantly not necessarily giving my mother the kind of support that that she could have benefited from. Granted, she had me, right? But I think so. When I'm still in the hedge fund industry, by the way. I sit on the board of a number of funds, so I shouldn't just be upfront about that. But when I wrote the book, it was really with her in mind, and where sort of a very important first premise is this whole concept of beating the market, and we can talk about what that means. But that it's actually an incredibly hard thing to get through, although it's a simple concept. It's sort of like, can you, through active engagement in the financial markets, and we can again define what that means, but think of it as stock markets, right? Can you better than the market know if Google or I guess neither is called Google or Facebook anymore, but Google, Facebook, Nvidia, or Vodafone is going to go up or down in the next period, and I think getting people to the point where they're accepting that that's overwhelmingly likely that they can't. Certainly when you introduce costs, both friction costs of trading, but also often there are tax consequences and so forth.
Yeah.
And that's before you get into this whole idea that you probably don't have a very optimized portfolio. If you happen to buy a bunch of tech stocks in the United States, you have all sorts of exposures you may not know. So there are all sorts of things embedded in there.
Yeah.
That I'm trying to address.
And you talk quite often in the book around the concept of having an edge. Do you want to maybe just elaborate on what you mean by that?
Yeah, I only later realized that it's not a broad term. It's kind of funny, I write a whole book about it, and I didn't realize that that's not something everyone knew what it meant. But having an edge is like, think of it as having a market advantage, being able to beat the market. I guess it's finance jargon. I shy away from that at all costs, but it's like, it's basically, can you outperform the financial markets through active trading or active engagement in the markets, right? And then you're considered to have an edge in that market.
Yeah.
So that's all it means, really.
And
you can have an edge in various ways. One is stock picking. One is like knowing if interest rates are going to go up or down. One is knowing if gold is going to outperform silver, or Japan is going to do better than Australia, or whatever, right? Those are all examples of edges. And one of the problems is there are seemingly infinite ways to have an edge. So, like, how could you not? Almost, right?
Yeah.
So.
And would you, just to bring our listeners into a brief history of your career, Lars, was it the case that you once considered you did have an edge when you were in the hedge fund industry? And did you come full circle, or bring us kind of the journey? Yeah,
I think so. So the answer is yes, I did, absolutely. And I think, so my background, just give you the 10-second version of who am I. So I'm Danish originally. I went to college and graduate school in the US and worked on Wall Street for a while. And then a couple of years after business school, I moved from New York back to London, because of my family reasons, really. And started a hedge fund there in 2001, 2002, it's a long time ago now, and ran what's called the Market Neutral Special Situations Fund in London until, incredibly fortuitously, right before the 2008 crash, I returned the capital to the investors, so the external investors just sort of kind of kept my own money there, if you will. And then since then, I have been involved as a board member and investor in a bunch of different funds, and talk about it. But separately, I'm now running a business in the voluntary carbon markets, because I've got very interested in poverty eradication, and through that got involved with the carbon markets in developing countries, and so spent a lot of time in that space, but completely separate from this world. So that's my background, yeah. And,
okay.
But come back to your question of did I think I had an edge? Yes. But, so the point I'm making here, well, first of all, if I didn't think I had an edge, I would be irresponsible to charge people money to manage their assets, right? Charge people fees, because you're selling, as a hedge fund, a product where you somehow think you can outperform the market, which is typically, the technical term is called generate alpha. Alpha is a term for outperformance of relative to some benchmark. So absolutely, I thought I had an edge, and returns also suggested that we did. I will say, though, that the reason, there's 2 points to that. One is, just because someone thinks they have an edge, first of all, it doesn't make it true, but second of all, it's not so relevant whether the ability to outperform or having an edge exists in the world. What's important is that you, as the steward of your assets or your personal financial life, have the ability to either yourself have that ability to outperform, so have an edge, or can recognize someone who has it. Right? So that's very important. So that when I said it before, that you can pick, think of it as you picking, is Microsoft going to do better than Google? You know, to a lot of people, hopefully the answer is, who the hell knows? I know I don't know. Right? Now, there are a lot of people out there that say, I do know. And if you, Benjamin, will only give me all your money, I will pick one and not the other continuously, and I'm going to charge you a fee for that. So that's, one is the direct route. I go in and I set up a brokerage account or an online thing, and I pick it. And the other way is that I pick someone to pick it. Think of it like a big mutual fund, Fidelity or whatever they're all called now, right? Mm-hmm. Now, so that's where a little bit of statistics is important. And these numbers change continuously. But let's take like the most known stock index, the S&P 500. So imagine you had 3 ways of investing and getting that exposure. Let's just say for a minute the S&P 500 is the world, which it's not. And we can talk about why you should pick the world. But version 1 is you go in yourself and you pick a subset of the S&P 500 that you think is going to outperform, and you don't pick the ones that you think are going to underperform. And over time, if you're right, you're going to do better than the S&P 500. That's version 1. Version 2 is that you pick someone who is typically up on a big billboard next to a highway or in an airport or online saying, Bob Smith is the best stock picker of all time, the new Warren Buffett, blah, 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 has outperformed by 5% a year for the last 20 years. What could go wrong? And you give Bob Smith your money in some sort of a mutual fund or investment fund, and you pay a fee for that. And Bob Smith will have much larger expenses typically on top of the fees. That's version 2. Version 3 is that you somehow blindly follows the S&P. Now, so we talk about what the S&P is actually. It's obviously 500 stocks, but how is it put together? How often does it change? All that stuff. That's version 3. Now, if you yourself can beat the market, do number 1. Go get rich. Be Warren Buffett, right? Overwhelming likelihood you cannot. That doesn't mean it doesn't exist, but that's actually, for your purposes, irrelevant whether it exists or not. Version 2 is Bob Smith. You pick Bob Smith to pick your money, and these ads are incredibly convincing, and we can talk about whether they're very easy to make convincing. Version 2 is Bob Smith manages your money. Now, statistically, this is where you need a little bit of statistics. Over a 10-year horizon, if you pick 1,000 Bob Smiths, and there are way more than 1,000 around the world, about 90% of them will not outperform the S&P 500. Right? So obviously there's a range. Now there's lots of reasons why you're only going to see the ads for the good ones, right? The ones that sort of after the fact turned out to be great. But the fact is that about 90% of them don't. So that then begs the question, can you pick the 10%? Can you pick the actual future successful Bob Smiths? And yes, there is no correlation between past performance and future performance. So the fact that Bob Smith was successful the last 10 years statistically doesn't make him more successful the next 10 years. It's not, I wish it was that easy, right? So that's question 2. Can you do it yourself? That's 1. Can you pick 1 out of 10 that will do so in the future? That's point 2. Again, highly, highly unlikely that you can do so. Now, again, it doesn't mean that no one can't, but you can't. And you also can't pick the people that pick the people that pick the people, right? That's all equally unlikely. So what I'm trying in my work to get to is that for the vast majority of people, the vast, vast, vast majority of people, including my mom, that just is a non-starter. Do version 3, assuming for a second this is the only choice you have. And the reason is that number 3 makes sense is you will do exactly average because they're simply replicating an index. Someone will be able to replicate that index extremely cheaply. Extremely cheaply. And over time, that adds up to a lot of money. Right? And that's what you should do if you had if those are the 3 choices you had.
Yeah.
And then we can talk about how that extends. But just idea, order of magnitude, I think I mentioned this in the book. Take an example of someone who drives a train on the London Underground and worked from the ages of 26 to, I want to say 66 or something like that. Don't hold me to these numbers, it's been a while. But, and they take their salary and they take 10% of their salary and they put it in the stock market. And either they give it to Bob Smith or they put it in an index track or something that tracks the index like the S&P 500 is. And the difference in fees, so on average, Bob Smith will do like the average, less the fees and expenses. And over the lifetime, this person who drives the train on the London Underground, I think makes 60,000 pounds a year, something like that, will pay the equivalent in fees to the financial sector, including the lawyers, the accountants, this, that, right, the brokers, the manager, so forth, of about 4 Porsche cars. Right, so this is a guy who was not driving a Porsche, has over his lifetime paid the equivalent in fees of 4 Porsche cars to the financial industry. It adds up. But every month, it's a tiny amount. But then it's the compounding on its own. That, by the way, assumes you don't pay tax, which obviously you do. And it assumes that certain fees and growth in capital over time, in line with the story. So pretty reasonable assumptions.
Yeah.
And it's crazy.
Yeah. Yeah, we had an episode a few weeks ago, actually. You're probably familiar with the story, Ronald Reed, the millionaire janitor, who basically sounds very similar scenario here to what you're discussing, in that a modest income, a modest lifestyle, but by making that conscious effort to save and invest every month and to invest in a way that recognized his limitations, he became very wealthy, whatever that meant to him.
Oh, that's actually really nice to hear, yeah, because most of the time the stories are the opposite.
Yeah.
It's someone who invested in some sort of a cryptocurrency and made a bundle, or someone who bought NVIDIA when it was worthless and made, and keep in mind all the media, and I don't want to be one of these conspiracy theorists because I don't think there is one at all, but who's actually incentivized to tell the story of the janitor?
Yes.
Like, it's not a particularly compelling news story. It's pretty boring, actually, right? It's someone who did something very, very sensible for a very long time and did pretty well, but he probably also didn't spend a lot of money, and it wasn't very glamorous, and he certainly didn't go buy Porsches, right? And whereas the news stories that sell ads and involve some flash, something exciting, something like, so I remember I did a lot of media around my books, and whenever I was on one of the news channels, actually there's more in the States than in the UK, they would always say, like, this is not exactly something that's going to help us sell ads. Because the ad, right, you have your 5 minutes and then there's a little break and then 5 minutes to, right? And in between me talking like I am now would be some e-trading platform or some fund manager saying, come invest our money with, like, I'm Bob Smith, I'm going to get you rich. And it just didn't work that between the next segment was a guy like me. So it wasn't actually in CNBC's or Bloomberg's interest to have me come and say this. And they're not bad people. It's not that they don't get it. And they all agree, and certainly when you're off camera. But it's just not what paid for the show, right? It's just not how it worked.
Yeah.
So.
And to get your take on, this is kind of diverging into the area of behavioral finance, but one of the biggest bugbears I encounter is in almost all other aspects of life, we prefer the easy route, we prefer simplicity, but for some reason when it comes to our personal finances, we just can't settle to be average. Is that kind of a trait you've seen manifest?
No, absolutely. I think it's a very good insight. I agree. If I were to venture a guess, it's that, okay, let's say on Friday you go have a dinner at home with a bunch of your friends, and there are two people talking about their success, and one is like how he picked NVIDIA shares. I keep saying NVIDIA because everyone knows, right? NVIDIA and Microsoft, and they all went up massively. And he doesn't actually have to say a lot about his insights. He just had to do that, and everyone is sort of like, oh yeah, really clever guy, right? Like really smart guy. Now, imagine someone further down the table did the same thing, but either bet on horses or the lottery, and got equally rich, even richer. People at the table would typically be like, ooh, the guy has a problem, right? He has a gambling habit, or like, that's not going to work out. Now, I'm not saying that investing in stock markets and picking stocks is the same as betting on horses or playing the lottery, but I think society has certainly helped make active investment seem like an astute, and you're somehow informed and educated and someone we should listen to, compared to other forms of, I wouldn't call it gambling, but like, and the reason is also, like, keep in mind that in a rising market, even after all the fees and expenses, and over time stock markets do tend to go up by 4 or 5% above inflation, right? Like in a very, very long term. And so you do make money, and you tend to remember your winners, right? So there's huge recency. We remember our winners and forget about our losers, and we don't do portfolio statistics to say how well we actually did. So there's all sorts of ways we can tell the world around us and ourselves that we're actually really good at this. And the feedback from the world is, wow, you're good and clever.
Mm-hmm.
And so I do think there's an element of that.
Yep, yeah. And we've kind of talked so far about the angle of an investor being financially literate and they're considering the kind of trade-off between active management or passive. But similarly, there are some listeners to the podcast and some of the general financial illiterates out there think that cash is a safer asset class and that investing is not really for them. And we call it the terminator of wealth that is inflation. Do you want to maybe just give a little bit of your views on that?
Terminator of wealth, I like it, yeah. Wow, okay, well, let's talk about risk.
Yeah.
Because, and I'd also ask, what is cash? Right? Is it like a bunch of pound or dollar bills under your bed?
Mm-hmm.
Is it, presumably they mean in a bank account somewhere, presumably one, maybe get a bit of interest these days, maybe not, right? And, now, so you're right, in most cases you will make less in interest than you would suffer from inflation, right? If you I have a Barclays account in London and I don't think I get any interest. I should check, actually. I don't think I get, at least get Revolut, right? They pay some interest in some cases.
Yeah.
But it's absolutely right. Over time, that will erode your wealth. Now, you're also probably not taking any risk. And that's important, right? So I don't think it's fair to compare the equity markets to cash. But your money in cash is not a good place to put it unless you need it tomorrow. Like if you have, and that most people don't need that amount of cash tomorrow, right? Like if you want absolutely zero risk and you're a pound investor, the closest thing you can get is short-term UK government bonds or gilts. And there you will get whatever interest the UK government pays, and it's a lot less than you should reasonably expect in the stock market, but you're also not really taking any risk. It's the closest thing you can get. And in US dollars, it's the US government. If you're Danish like me, it's Danish kroner. If you're from Timbuktu and the local currency doesn't have a super low risk alternative, you don't have a local currency minimal risk asset, and typically there you definitely don't want to hold cash because inflation will probably be very, very high, right? So I think for me, cash is very often a bad idea. At least do cash alternatives if you want to take no risk whatsoever.
Mm-hmm.
So I think that absolutely falls. But there are products that you can buy access to short-term. The reason, by the way, it's short-term is because long-term government bonds do change in value, right? Like as interest rate change, then the value of long-term government bonds change, but short-term they don't change a lot, even if interest rate changes. So that's another risk you can make go away. But yeah, don't just hold cash unless it's you need it tomorrow to pay a holiday or buy a car or something, right? Yeah.
And in your book. And obviously this is not advice to listeners, but you do profess for a certain kind of portfolio comprising largely of the stock market and bonds. Do you want to maybe just do a bit of a dive on that?
Yeah, I mean it was an attempt, and I still think it's true. By the way, it's like again, think of my mom. So someone who comes to the point where they acknowledge they can't beat the markets. Like that's not helpful in itself. To then say, oh, you should put it all in the S&P 500, because think of it this way. Let's say you have £100 and you need £90 next year for open heart surgery. That's a terrible example. But you desperately need £90 next year. The worst thing you do is put it in the stock market, because it could easily be down 10% and you could be short, right? So then you say, well, so clearly my risk profile is such that I shouldn't take a lot of risk. What should I then do? And we just said, look, good answer there is to buy UK gilts, because at least you get some interest and it's very, very low risk. By the way, we can talk about deposit insurance. I don't know how interesting that is, but like up to a certain point, your money is guaranteed by the UK government, right? But park that for a second. The idea is, and this is just why your profession is a super important one, is that talks about some sort of a risk continuum, Let's say you're ready to take a lot of risk because you can afford the losses. Or you're young and you're thinking, like the train driver, you're thinking 40 years or 30 years. Well, then you will, in overwhelming likelihood, make more money investing in the stock markets, the risky stock markets. You could even invest in riskier things than that. But let's just say those are the two choices, right? Now, what do you expect to make from that? Well, if I knew that, that's a crystal ball, next level crystal ball, right? But let's say historically for stock market risk over a long period of time, all the ups and downs, you will have made about 4.5%, 5% more than inflation. All sorts of caveats, all sorts of exceptions to that. But you can also lose an awful lot of money in those cases, and we tend to forget those, particularly when stock markets have been very good for a while. And yes, I get the whole that average is higher when you just had a bull run and lower, but we're talking very long time periods. So okay, so one pocket you can reasonably, with a lot of risk, expect to make, call 4.5% above inflation. The other pocket is, let's say you're borrowing short-term gilts, and you can reasonably expect to make what, 1, 2, but less inflation is still less inflation is 1 or 2. Now. And then you can combine those. So now you have two things, and there are ways to buy those that cost almost nothing, like 0.05% a year. And then you have to have an account where you can keep it, and that every bank offers one, or online services do it for virtually nothing again. So you literally not spend anything, and you now have two buckets. One is the risky stock markets, and the one is this low risk asset. And how much you should buy at each depends on your attitude towards risk. And this is where someone like you come in, because it's not necessarily an easy thing to think about. It's like your family planning, you have kids, are you young, are you old? Very, very often there will be some sort of a tax impact of what you do. There will be a tax benefit if you do this product instead of this product. This is why being someone with a more sort of general approach like me can be a little bit thankless, because like I got approached by someone in your kind of job, but from Poland a couple of weeks back, and I sort of like, well, I don't know the first thing about Polish tax legislation when it comes to investments, right? Like, or the relative risk of the Polish zloty. I just don't, right? And besides, it changes all the time. That's why people should contact someone like you, is that you can reasonably be expected to not only help them with those choices and know about pension advantages or tax advantages, but also like think about other stuff. Like, you know, let's say, hypothetical example, you have £100,000 in savings, and you have a house that's worth £1 million. Well, that matters, as opposed to the person next door who is renting their house and has £100,000 in savings. Or if you have a lot of exposure to the kind of risk that the stock market is, that's a different kind, because through your job, let's say, or your education or something, that's a different kind of risk than someone who works at the Treasury or works for the government or is a teacher or something, right? Because, yeah, it's a different risk that you probably could use some help thinking through.
Yeah.
Or if you're about to inherit, like you happen to be like Bill Gates' son, well, even if you don't have a lot of money, it should impact the fact. Actually, weirdly, I happen to know that I read one of his books, and apparently his kids aren't going to inherit anything. So maybe they should. So maybe they're a bad example. But someone who's going to inherit a fortune. Well, of course, it should matter in terms of how they think about their financial planning. So there are lots of reasons that people certainly should contact financial advisors. Absolutely. But a financial advisor that then says, I think, you know, Microsoft is going to outperform NVIDIA, I'd be really cautious there, because if the person really knew that, like really, really knew that, or some variation, there could also be Bitcoin is going to outperform Ethereum, or gold is going to outperform. So there are a million ways to do this. I'd almost say, well, why are you talking to me? Why are you not just out there making bundles of money for all these massive institutional investors?
Yeah.
That would pay you high fees and never bother you with like teaching like Mr. Smith how to manage his personal assets. Right? Like, I remember I had a chat with my cleaning lady and her husband, and they were debating investing in a sort of a crypto investing scheme. And they were going to invest, I think it was the equivalent of around £10,000, right? And I was just like, look, imagine a crypto investing scheme that's guaranteed to double your money, and they're raising money in £10,000 clips. That makes no sense. It's so obviously a scam. And I'm not saying people by and large are scammers, because I don't think that's true at all. But just if someone really knew how to beat the, $100 trillion financial markets with all this incredible access to information, to people, to computing power, et cetera, they would not be raising money 10 grand increments from you.
Yeah. Yeah.
Certainly not just charge you a small fee to be their advisor. Certainly not, right? So it just doesn't make any sense.
Yeah. Yeah, I've seen it a few times in my career where I've never personally had a client who is a fund manager per se, but I have heard on the grapevine that their personal wealth strategy differs very much from how they're running money in a professional capacity. And I think that is a red flag. Similarly, if your financial advisor is suggesting certain hot stocks or active funds, whereas in the reality they are tracking the S&P index and their own personal wealth plan, that would give me a bit of the concern as a client, for sure.
Trust me, I see a lot of that. Can I just defend them for 1 second?
Please do. Yeah. This should not be a bashing completely.
That may not be what you think, but it is absolutely true. First of all,
okay.
It is also because of correlation risk. So imagine you couldn't replicate our returns, but let's say we sort of were S&P 500 trying to beat it, and now I had some savings, and I have a vast majority of my wealth is tied up in the company I started, right? That's the value of that business is high, and that business is highly correlated to the index I'm trying to outperform, right? Because that probably explains 90% of the returns. Now, for whatever savings I have, it makes sense to do something else as a hedge, right? It's don't do whatever you were doing with your career. Do something else with your personal savings. Like imagine a scenario where you're doing an AI startup and you have all this stock and it's doing whatever, you struck gold and you're doing really well in your career and you have £1 million worth of stock in your AI startup. On top of that, you have savings of £100,000. I would tell you, don't put that £100,000 into your AI startup. I get the whole don't hedge stuff, but put that in something really boring. Don't buy a NVIDIA stock either, because the chances that NVIDIA is going to move in the same direction as your AI startup is very high. Do something else.
Yep.
Right? So if this AI thing goes pear-shaped or goes terribly wrong, everything doesn't go badly wrong all at once and for the same reason. So the charitable interpretation of why they do something else is that it's a way to reduce their personal risk. Actually, I'll tell you who did that, and actually I think came out looking pretty sensible, was the guy, I forget his name, the guy who ran Ryanair.
Is it O'Leary? Yeah, yes.
I mean, I might be getting this wrong, but I remember him being like, no, I sell my Ryanair shares once in a while, because what if we muck this up? And he was a straight talker, right? What if we muck this up? I don't want to be left with nothing. And it doesn't make me a better CEO to be desperately needing this to work, because it starts impacting. So I kind of want to, and what I think he was saying is, maybe he was using different terms, but he's kind of saying a version of this, I don't want to have all my eggs in one basket.
Yeah.
Right?
Yeah.
But I definitely think that a lot of investors can learn from that. Don't have all your eggs in one basket.
And that's maybe a good link on to the subject of property. And In the UK, we love bricks and mortar. It's one of the probably biggest bugbears in my profession is educating clients that the route of buy-to-let investing is not the yellow brick road that it once was for various tax and logistical complications. But from a investment standpoint, I think you've got some fairly strong views on where property as an asset class fits into the portfolio.
Yeah, it's a funny one because after I started writing, I also did some YouTube videos. My publisher said, "Do you mind doing that?" And which is great, probably. You get to talk about anything, and no one gets to talk back at you. Right? But I've also been on podcasts, most all over the world, and it's kind of interesting because whenever property comes up, the angle is entirely dependent on how well the property markets have done. So if you're on a podcast in 2010 in Miami or Berlin, they're like, how do you avoid properties? If you're at the end of the biggest bull market in terms of property valuations in the UK for the last century, they're like, how do I get more? Right? And if someone like me comes along and says, don't do it, it's almost like, how dare you? You're an apostate, right? And so the logic is as follows. For most people, I get all the problems with getting on the ladder. But put that aside because that's a whole different set of issues. For most people, the investment in their property is overwhelmingly the largest asset. Certainly if they've had it for a while and it's gone up in value and they've paid down their mortgage, as some people are able to. Then they might have some savings, and they often think, there's a house down the street that I can fix up and do well out of, right? And what a great investment, partly because this was a great investment. Now, and it may work, don't get me wrong, and when I say this to people, they often say, yeah, you're right, but it really worked, so shut up, right? But the reality is you are now incredibly correlated in your portfolio to the property value in specifically in the area you live. You're incredibly correlated to change in rules and regulations, and the likelihood of everything going terribly wrong in your financial life all at once has massively gone up. And the reason is, well, not only that property markets tend to move the same way nationally, but certainly locally. And not only that, but it could even be, and there are cases where the local economy is subject to one factory shutting down. I mean, it's probably not what most people think of, or some local event that impacts all the houses at the same time in the same area for the same reason, but probably also impacts the rest of your life, your job, or now you have to move or something, right? So I get it. I know people have done well out of it, but by and large, it's certainly something to look at with skepticism. And people feel very, very emotional about this because they're like, well, shut up, it's my house. It's not a part of my portfolio. And look, I own my house. There's a lot of emotional value there. I get it. So I'm not blind to it, but I just think it's important to understand that, you almost have to look at your portfolio holistically, right? It's all part of your portfolio. Your future earnings is a part of your portfolio. Your future inheritance is a part of your education is, but also your house and your local economy and all of that stuff.
Yep.
Now, it's not typically what we talk about, but I think, again, it's a good reason to talk to an advisor.
Yeah, I mean, I think what I often see is clients who maybe have a bit of surplus wealth and they go down the buy-to-let landlord, landlady route. And a lot of the reasons I often think that derives from is the tangibility of property as an asset class. I can put my hands on it. I understand it. Whereas this elusive concept of the stock market, what the hell is that? That's the uninformed views I often see.
I agree. I mean, and also I think one thing just to keep in mind there is if you're a landlord, it's a way to, obviously that involves some work, some labor. And part of your return is actually that you get paid for that. So in some ways, this is a bit of a job.
Yeah.
Right? And some people may say, I have some ability to work a little bit, but I don't want to go work, at the, I don't know, local shop or something, right? But here's a way for me to do a bit of work, and I'm indirectly getting paid for it.
Mm-hmm.
So there's a bit of that. But generally, from a portfolio perspective, it's quite dangerous.
Yeah. Do you also think?
And again, trust me, I remember I was on a podcast in Sydney or Melbourne, and there was these two guys that had both retired from selling all these properties, and they'd done it. But they're actually lovely guys, right? And when we had this conversation, they were just like, "That's the craziest thing I've heard," right? But they were like, "Yeah, it's survivorship bias, right? Selection bias. You're again, go to Las Vegas, which had the biggest property decline and personal bankruptcies, et cetera, and it'd be the opposite." And of course, if you know before the fact what's going to be better, if you told me right now that you knew that in Edinburgh the property prices are going to double the next decade, yeah, go find a way to get rich off of that. But it's a pretty big thing to claim to know.
Yeah, it comes back to that concept you talk about of having that edge. And that we say for having a crystal ball, we don't.
Yeah, it's overwhelmingly likely we don't.
Yeah.
Right.
Yeah.
I remember I had to explain this through. Actually, I always use S&P 500 because we all know it, right? But this whole idea that you can look at 500 stocks and you just have to pick one, and you can pick any one of them, or you can even unpick one, and you're ahead. That's it. Just 1 out of 500. It's how could you not, almost, right? And the fact is, you probably can't.
Yeah.
It's
yeah. No, I think we're very much on the same page here that not reinventing the wheel is often the best strategy. And sometimes when I put forward these simple strategies to clients, there's always that human temptation to want a little bit more. Or what happens if, we call it in the podcast, and I say to clients, financial Armageddon strikes, and I believe you referred to it as the concept of apocalypse investing, Lars. Do you want to maybe just share a bit about that? And what I'm really alluding at is, should there be other things we should be dabbling in just to hedge our bets?
Yeah, I think so. I think I'm sometimes too much a theorist, right? Because obviously apocalypse is a dramatic term, but when we talk about things being bad, I'm always like, well, what do you mean by that? What's bad? Is World War II, we can agree, was pretty bad, right? COVID was pretty bad. Stock markets being down 20% is pretty bad for some people, right? But what kind of risk do you wanna invest with that you implicitly accept? Implicitly, I think we're all accepting or we're investing in a world where Barclays and the UK government doesn't go bankrupt tomorrow, right? We accept that when you go to Tesco's, your bank card will work and you can get some food, right? Otherwise, you're in the world of, the term preppers?
No, I don't.
Weird. So preppers, it's a subculture. Can I make a movie recommendation? This is a crazy movie. I just saw the TV series called The Last of Us.
Yes, okay.
It's great. It's a great TV series, and it happens after a horrible zombie-like outbreak of a disease that kills most of it. It's very U.S. focused, but in the U.S. And one of the people that survives in the movie is a prepper, because he was ready. He was ready for the worst thing that could possibly happen. He had ammunition, he had food, he had a way of creating a whole mini society, right? So he was ready, and he won. I won't say what happened in the end, but let's just... So we can agree that's pretty extreme, right? Most people are not like that, but there is actually a subculture of people called preppers, and you can find them on Reddit and places I actually looked at some of it for my book, because I thought it was fascinating, frankly. And yeah, there's a whole you're the coolest kid in class if you can survive 3 years in the wild in northern Montana, right? Scotland in this case, in the hills. But most people don't invest like that, because that's not, when we think risk, we think that's too remote or we're all screwed anyhow, right? But I think it is important to think in terms of, sort of say, more down 2008 kind of risk. What would happen to you if that happened again? or some version of that, because it's never exactly the same. And what impact would that have on your life? Like, would you lose your job? Or would whoever pays you, and that could, by the way, include the UK government having to make massive cuts, right? Or cutting welfare in dramatic ways, or cutting pensions in dramatic ways, because 2008 could have been the UK government going defaulting, right? Like, who knows how close we were to that, but that would perhaps be the next step. And I think then think of where are you in your life? Are you young? So this is like you have a long lifetime to make up for this, and you sort of near-term needs are okay. And then you take that into account. And a lot of that is also, how do you feel about this stuff? Again, it's not a bad idea to talk to a financial planner about it. It almost, I don't know if you have clients like this, but you almost become a psychologist. Like, if you can't stay up at night, or if you can't go to sleep at night because, you know, the stock market's down 10%, then you probably got too much risk in your portfolio, right? Like, you know, sometimes it's gut feels like that, I think, are useful.
Yep.
But I do think it is, to some extent, you know, a personal thing.
Yeah.
Like, how are you equipped to deal with it? Or do you have sick family members you got to look after? Do you? You mean? So there is a continuum of risk. I just always take issue with people defining risk as the same thing somehow. Like, oh, we all know when I say risk, I mean stock market is down 25% and the economy is contracting 2%. Well, if we defined risk that way, it'd be very easy. We can be like, okay, this is what that would mean for your portfolio. How do you, like, would you still be okay? Right, so I say, well, okay, so some people that's risk. For other people, it's the Armageddon or the apocalypse, right? Which is, of course, hopefully doesn't happen in our lifetime, but some people want to be ready for that. And then some people, I've also met people. It's actually funny being, having been involved with a lot of media around this, is you meet all sorts. Yeah, there's some people like that. Actually, it's pretty rare, but there are some people that they feel better about more risk. It sort of makes them feel alive. It's pretty rare, but you've seen it, and you just, a lot of economic theory goes out the window. Yeah,
it's a wide-ranging concept, varies from person to person, and sometimes what you perceive as risk or, you know, risky or non-risky on paper, it appears very differently when it actually occurs in your wealth plan, when it hits your portfolio. Does it keep you up at night, as you alluded to? That's the real test.
Yeah, and I think, I mean, most people in the Western, or certainly in UK, hasn't seen anything like really, really, really bad in their lifetime.
No.
Right? That doesn't mean it won't happen. Let's hope it doesn't, but like, maybe people say, well, you know, that probably means I don't really have to prepare for it, because think of all the wasted upside, right? If I was being too conservative.
Yeah. Well, no. The last question I kind of really wanted to ask you, as I'm conscious, you know, we could probably talk about this for several hours. We're very much on the same page, Lars. If you could give one simple piece of money advice to your younger self, what would it be?
Oh, that's a great question. I probably wouldn't give money advice, because this is what I studied pretty closely. I actually felt this way about, I would say one thing I did well is I always thought about this concept of, can I beat the markets in financial terms? And the reason that was so important in my life is because it made me question everything I did in the context of finance. That could I provide a product where that was the case? If so, it's fair to sell it. Like today, in my personal life, I invest in index funds. I do the same thing we've talked about. And I take advice on when it comes to tax, because I know people know a lot more about that than me. I would say, like, for depending, and not to talk about how my life has turned out so far, but your janitor's right. You know, if you save a little bit of money all the time, yeah, maybe forego some stuff, but a lot of people can afford to forego £50 a month or more even, and that adds up to a lot. And the benefit in your life from having this feeling of I'm going to be okay is incredibly valuable. And I tell the younger self, like I tell my kids now, it's the almost emotional value from that is really, really worth it. So start saving, get in the habit of, most of us can find 5% of our income and put somewhere that just compounds over time.
Yeah.
That doesn't mean it always works out, but on balance, that means you're going to be much, much better off longer term with relatively small, if not completely irrelevant, outlay now.
Yeah.
And that's just, it's so obvious, but I can say that as a 53-year-old, it is definitely true.
Yeah. No, it's great advice. Great advice for certainly for people at the start of their wealth building journey, and even further down the road, the principles still apply. So I guess just to kind of close things now is obviously we've talked a little bit about your main book being Investing Demystified, which I can attest is a really top quality book. If the Heads Up on Money nerds out there want to find out a little bit more about your work, Lars, or check out more information, do you have a website or anything?
Yeah, no, I do. It was funny when those books come out. I did a website. There's not much on there, but more importantly, they asked me to do some YouTube videos. They asked me to do 5 exactly, so I did 5 with a guy they introduced me to. So I did 5 videos, and then I actually found it was so easy. I literally flipped open my laptop and did a few charts. It took me about an hour for each video. So I've then done some videos about all these topics, and I just ended up enjoying it, frankly, because it was a way to, I don't know, you feel you speak in a vacuum a little bit, but so some of the topics we discussed here today have been, I have a video, including property and stuff, and insurance, something we didn't talk about, something I feel weirdly passionate about. I think that would be a good place to find out more stuff.
Great. Well, no, I'll put some links in the show notes for people to check out Lars's website, and I'll link in those videos as well if they're still up on YouTube for people to.
Yeah, if you know how to spell my surname, you can just put my surname in there.
Yeah. So for the sake of clarity for people listening who maybe might not be watching this online, etc., is Lars's surname is spelled 𝐒𝐢𝐬𝐬. So if you want to check out his work, you'll find him online. But just a note from me, Lars, just to say thank you so much for your time. There's lots we could have gone into, but it's been, as a high level chat, really beneficial for me. And I'm sure the listeners out there who value this kind of content will really appreciate you coming on to the podcast. So a heartfelt thank you.
Pleasure, Benjamin, and thanks for doing it.
That's
great you're doing it.
And just last question is what exactly are you up to now, Lars? So you said that you do serve on the board of a few hedge funds still. Do you have your investment funds? Yeah. Do you have fingers in other pies, further books in the works?
I know. Sort of as a side note, about 10 years ago got involved with poverty eradication work, and I found that fascinating. It's obviously, well, not obviously, but it's certainly not been a particularly profitable venture. And that, through ways I won't bore you with, led us into the world of carbon markets, which has an interesting overlay of obviously being the greening of the world, but also a lot of development economics, politics, technology in there. So I started an organization called Allied Offsets, which is basically is kind of a mini Bloomberg in the carbon markets, and really enjoy that because you work with young people working in an area that's fascinating and hopefully trying to make the world a little bit of a better place. Suffice it to say, it's not the first place to build up wealth.
No.
Well, maybe, but it hasn't proven to be so far. Let's put it that way.
Yeah.
So, but it's really good. It's really interesting work. So I really enjoy it.
Yeah. I guess creating wealth, not just in the monetary sense, but through enjoyment and something you're passionate about, which is brilliant. It's what I encourage clients to do.
No, absolutely. I couldn't agree more. Like to do something you're not passionate about, it's just so much less likely to work out. There's good statistic backing that too, by the way. So that's not just me talking.
No.
Yeah.
Well, no. Great work. So thank you again. It's been wonderful having you. Thank you to Money Nerds listening as always. Hope you've enjoyed that podcast episode. And if you have, please leave a comment, pass it on to your family and friends. The more people we get this out to, the better. to educate the financially illiterate out there that you do not need to reinvent the wheel. To quote some of Lars's work, you do not have an edge, money nerds. Neither does Lars, neither do I, but that's okay. We can still do pretty well. So thank you as always for listening. I'll see you next week on Heads Up on Money. I've been Benjamin Mitchell. Thanks as always. Goodbye for now.